Hey everybody, Craig Moser here. It is the 9th day of January 2023. Happy New Year to all of you. And this is my market brief. As I start, just so you'll know, if you have questions, you have things that you want me to just provide some information to you, be happy to do it. Our number here is 336-448-1086. 336-448-1086. Okay, let's do the exciting world of the stock market. It's been an interesting year, I'll put it to you that way. And so looking at the future of the markets, I believe that we're sliding into a recession. I believe that we will not see inflation go away in 2023, and that interest rates will stay higher longer than, what maybe some of the folks are saying. Optimism is great, but reality is another thing. I'm in the camp that we need to remain defensive. So let's look at a few things here. All right, to the charts. All right, as we look, for example, at what everybody seems to want to call the stock market, the S&P 500 index, here's what we see. Now, the window you're looking at here, this set of lines, red and green, is the daily pricing of that particular stock index every day for the past 5 years. So obviously, I've already had the discussion with you about lower highs and lower lows. So far, it seems like that's what's happening. I could be wrong out in the future, but I don't see a chart pattern that gives me encouragement to go in and buy a bunch of stocks. I'm not saying you shouldn't own stocks. I'm just saying that the pattern is down and follow the trend. All right, so that's domestic. As you look at NASDAQ, now NASDAQ is a different group of stocks altogether. This has been a much higher gain and a more significant pronounced loss. So just looking at the math of it and saying, how much did these guys lose since last November, which was their high? Right now, I'd say we're in the 30s, down maybe 33, maybe 32, something like that. So as you're looking at this, just understand, not making any money in that index. If you own stocks that fit into this particular type of investment, which is usually fairly high growth, then just expect that you either are going to have to be very patient. If you're in a taxable account, maybe you use some tax loss selling and put it into something that's better from a yield perspective. And then when there's sunnier days, you switch back into the left lane growth mode, if you will. All right, over the pond, Europe, Australia, the Far East, which is the EFI index. Think about Great Britain, France, Germany, Australia, Japan, Canada, those types of things in a single index without the United States. And that's what we're seeing here. Looks kind of similar to all the other ones in that over the last 5 years, this one didn't really go up as much, finally got a run, dropped, and is actually back up some. So should kind of be paying a little bit of attention to Europe, Australia, and the Far East. I will tell you their stocks are cheaper on a valuation standpoint than ours are. So something to look at anyhow. But again, haven't really made any money with these. It's been more of a rebound off of a bottom. So we'll see what happens long term. Emerging markets, IEMG is that symbol, at least the one we use. And this is the big three, China, Russia, India, and then there's several others with that, but those are the three primaries in here, and not a good chart pattern. A lot of people say that China is already in a fairly significant recession. Not sure I can say that, but I know that, with less people importing, with us building chip shops, like Intel building microchips, those types of things, these guys are going to start to lose some ground. And so don't be surprised if you see them act a little aggressively. I mean, you mess with somebody's money and that's what happens. The bond market. So ag is the symbol that we use for that. That is, we're using iShares here, but Vanguards will look the same if you did the total bond what's happened is as these interest rates have gone up, the market for bonds has gone down because all of those low interest bonds that were issued during the zero interest high stimulus periods, really from about 2009, 2010, very, very low interest rates are packed into these bond indexes because they have longer maturity bonds in here for a lot of them. And so they pay low interest. If you had bought a bond in 2020, you would have gotten less than one half of 1%. Today, you can get, I don't know, about 5. So you can see that the price of bonds would have to adjust if it already owned in this index low yielding interest bearing bonds, that type of thing. All right. So bonds don't show us any real upside. We've had a bounce off the bottom in every index that I've shown you so far. We'll look at gold. Gold is okay. I mean, gold is all right. So if you're trying to say, is this where I should park all my money? Just understand it can go down just as easily as it goes up. So just be prepared for that. It seems like some of the huge countries, China being one of them, has been buying some gold. And I think to be a major player in the world, you have to have a big inventory of gold. I'm not certain why that's so important. But anyway, nonetheless, gold has had a little bounce off of its last bottom, which was right here, and which was November. So it's not like we've been seeing a big uptrend in gold. And if we measure from the last high, which was 2020, yeah, we got a ways to go to get back to even. So those folks that bought there, they probably wish they bought lower. That's the best I can tell you there. So what's going to happen? Not a clue. My best judgment tells me that you need to stay more into the fixed income side now, because you can buy bonds now, not 2 years ago, but buy bonds now that yield in the 5s for investment grade corporates. Buy the real bonds that will pay interest and mature. I would, if I were in the stock market, I would buy things that have lower price to earnings ratios and higher dividends. So looking for those types of ideas. And we were looking through a few scans today, and these are just companies. I'm not really saying you should buy them or not. I'm just saying these are the types of things that might make some sense. When you look at, let me shorten this period up here, a company like Bunge. Bunge trades at less than 10 times its trailing earnings, pays a reasonable dividend, and is in a good spot in the economy. If you looked at ConocoPhillips as an example, upward trend, not a straight line, but upward trend, you're getting better than 4% a dividend, and you're paying less than 8 times what this company has earned over the last 12 months. Those are ideas like that. Shell Oil, just to look at a couple. Shell pays in the 3s for its dividend. You're paying 5 times what this company earned in the last 12 months. So you're not overpaying, versus if you looked at a company like NVIDIA, for your example, you could look at that and say, excuse me for that, I'm sorry, I'm cutting this off. You could look at this NVIDIA and say, wow, the chart's not up. It pays only 4 cents a quarter in a dividend, and I'm paying 63 times its trailing earnings. So you're paying a much higher multiple for this company than you would be for the ones I just showed you. This company also is capable of very significant upside. You see, I moved that to a 5-year chart. Right here's where it is now. So these higher flyers, I would wait to catch that wave for a little bit later, to be honest with you. These are more aggressive strategy type stocks, and just be careful here because the economy is not in expansion right now. It's probably in recession. So just take that in mind when you're buying a stock, is that dividends, what the multiple of the stock is, the price versus what it earned over the last 12 months. And the higher that number is, the higher it could possibly go up, but the lower it could possibly go down. And it's usually pretty rough on these high PE stocks and higher flyer type ideas. Okay, guys, that's about all I have for today. Just wanted to go over a few things and tell you that not overly encouraged that the world's just already better. Inflation's there for a while. You know, you will see unemployment start to lift if the Fed does its job. I'm not saying that's a bad thing. We need to work on what it costs from an employment standpoint. And then we will also see what happens with the Federal Reserve moving bonds off of their balance sheet and trying to be more fiscally responsible. All right, that's it for today. If you have any questions, again, 336-448-1086. And with that, I'll bid you a good day.